Buried inside federal law right now is a specific dollar threshold. The second your checking account crosses it, a report gets quietly filed with a government agency. No notice, no heads up from your bank, no phone call. It simply happens behind the scenes. But the real danger isn't the report itself. It's what people do the moment they discover that number exists. Because the one instinct that feels like self-protection, that one move that seems like common sense, is actually a federal felony. I'm Lana Maines. Every week, I put out videos to help you safeguard your money and navigate the rules that nobody ever hands you a manual for. If that's something you want more of, hit subscribe. There's a lot on the way. The number and what it triggers. Here's the figure. Under the Bank Secrecy Act of 1970, every financial institution operating in the United States, banks, credit unions, savings, and loans, is legally obligated to file a currency transaction report with the Financial Crimes Enforcement Network, known as FinCEN, anytime a customer conducts a cash transaction exceeding $10,000 in a single business day. That report goes in on FinCEN Form 104. It captures your full legal name, social security number, date of birth, residential address, the precise dollar amount, and the exact time the transaction occurred, down to the minute. The institution has 15 calendar days to submit it. You will never receive a copy. The bank is legally barred from telling you it was filed. That prohibition lives in 31 U.S. Code Section 5313. What actually counts as cash. I want to be precise about what sets this off, because people misunderstand this constantly. This regulation targets physical currency, actual cash, and in some cases, cash equivalent instruments like cashier's checks and money orders, a routine check deposit, a standard wire transfer, your Social Security direct deposit landing in your account. None of that triggers this rule. Those everyday electronic movements are not what the system is watching for. One more detail that catches people off guard. The bank totals your cash activity across the entire day. Deposit $5,000 at one branch and $6,000 at another location that same afternoon. And as far as the bank is concerned, you've moved $11,000 in cash. You cannot outsmart the threshold by spreading transactions across different branches. Here's where people misjudge this in both directions. If you're a retiree on a modest income, your deposits may never approach $10,000, and that might feel like safety. It isn't. I'll explain why shortly. If you're someone with substantial savings, you might be shifting funds between accounts, receiving pension payouts, or consolidating assets after a spouse's death. Every single one of those events is a potential flag. Both groups can come through this fully protected, and I'm going to tell you exactly how. But first, understand this. A currency transaction report on its own is not an accusation. It's mandatory paperwork. Millions of them get filed every year, and the vast majority lead to absolutely nothing. The report itself isn't the threat. The problem is what comes next. The second report. No dollar floor at all. That leads to the second rule that almost no one talks about, because $10,000 isn't even the number you should be most concerned about. The number that matters most sits below it. There's a second category of report banks file, and this one has no monetary threshold whatsoever. It's called a Suspicious Activity Report, a SAR, and a bank can file one on a transaction of any size. $2,000, $500. There is no minimum. The trigger comes from the institution's internal compliance software scanning your transaction history for patterns. Not crimes, patterns. And the pattern that trips a SAR faster than anything else is a sequence of deposits that, added together, would have crossed $10,000. Diane, when legal money gets flagged. Consider a woman named Diane. She's 67, a retired registered nurse living just outside Nashville. She sold her car for $11,000 in cash because the buyer showed up without a cashier's check that day. Diane had heard somewhere that $10,000 was some kind of government tripwire. So she deposited $5,000 on a Tuesday and the remaining $6,000 on a Friday. 2 separate trips, her own money, a completely lawful sale. The bank's software detected 2 sizable cash deposits within a single week on an account that had never held more than $3,000. It filed a SAR with FinCEN. Diane did nothing illegal, but that report now lives in a federal database, cross-referenced against everything she does from that point forward. And here's the part that costs people the most. The bank cannot tell you a SAR was filed. A bank employee who tips you off commits a federal crime, literally called tipping off, punishable by up to 5 years in prison. The silence isn't an oversight. It's the law, the instinct that is a federal felony. All of this leads to the most dangerous element of the entire topic, because once people learn about the $10,000 reporting threshold, they all share the same reflex. And that reflex is a felony. Stop for a second. Pull up your actual checking balance, not last month's statement, today's number. Hold that figure in your head, because everything from this point forward applies directly to it. When people hear about the $10,000 rule, their first thought is almost always identical. Keep deposits underneath it. Spread it out, some today, some next week. That impulse isn't a loophole. It's a federal felony called structuring. Under Title 31, U.S. Code Section 5324, it is a criminal offense to break up, wise, or help anyone break up a transaction for the purpose of evading the currency transaction report requirement. You don't have to be laundering money. You don't have to be running a fraud scheme. If every dollar you own is completely legal, earned, inherited, gifted, and you intentionally deposit it in smaller increments to stay under $10,000, you have committed a federal crime. What it can cost you. The penalties are devastating. For amounts under $100,000 in a 12-month window, up to 5 years in federal prison, and fines reaching $250,000. For amounts tied to other illegal activity exceeding $100,000, up to 10 years. And in both scenarios, the government can seize the funds through civil asset forfeiture before any conviction occurs. The burden then shifts to you to prove the money was legitimate. While you're proving it, the money is already gone. This is not hypothetical. A federal watchdog, the Treasury Inspector General for Tax Administration, audited a sample of structuring seizures and found that in cases where structuring was the stated basis for the seizure, more than 9 out of 10 involved money from entirely legal sources. The statute was written to net drug traffickers and money launderers. In practice, it was overwhelmingly ensnaring ordinary, honest account holders. That public outcry forced genuine reform. In 2015, the IRS announced it would stop seizing legally sourced funds in most structuring cases. In 2019, Congress specifically restricted the IRS from seizing accounts based on structuring suspicion alone when the money came from a lawful origin. But here's the catch. Those reforms apply to the IRS. The Department of Justice can still pursue these cases, and structuring itself remains a crime on the books. The takeaway hasn't moved. Never break up a transaction to dodge that line. Why retirees get flagged more than anyone. Here's who gets swept into this most frequently: retirees who receive irregular large lump sums rather than steady paychecks. A final pension disbursement, a life insurance settlement, proceeds from selling a house or a vehicle, an inheritance, a retroactive Social Security payment that arrives all at once. These are not wealthy individuals doing anything out of the ordinary. They're cautious people whose income arrives in large, infrequent amounts that look unusual to software designed to catch criminals. And you will never be told in real time that any of this happened. It's also worth understanding why retirees specifically get flagged more than working-age account holders. When you were employed, your money moved in one predictable shape: a single paycheck, direct deposited, same amount, same schedule. Retirement income doesn't follow that pattern. You might have Social Security arriving on one date, a pension on another, investment dividends on a third, and then layered on top, occasional large one-time events, a required withdrawal, a home sale, a settlement. Automated monitoring systems are engineered to notice variation, and a retiree's financial life is inherently more varied than a single steady paycheck. On top of that, many retirees no longer have an accountant or financial advisor sitting beside them the way they might have during their working years. So these situations accumulate quietly, unmanaged, until one of them triggers a real problem. None of this means you're doing anything wrong with your money. It means the system was designed around a different, more uniform pattern than the one retirement income actually follows. The bigger picture, what a CTR actually means for you. There's broader context worth knowing. The Bank Secrecy Act was passed in 1970 to combat money laundering and organized crime. It was expanded substantially after 2001 under the USA Patriot Act to include terrorism financing. The system was built to catch criminals. It was never designed to target retirees, but the software scanning your account cannot distinguish between a grandmother relocating her own savings and someone moving illicit funds. Both patterns can look identical to an algorithm. Documentation is what tells them apart. And to be clear about what a CTR filing actually means for you, FinCEN collects the reports, and the IRS may access them during an audit if some other independent reason for suspicion already exists. A CTR by itself is not an audit trigger. It's a data point sitting in a database that only becomes relevant if something else brings investigators to it in the first place. A resource. Before we continue, the exemptions, the breaks, the refunds. Most seniors already qualify for these but never claim them. I've assembled everyone into a single guide, organized state by state and form by form, so you're not burning hours lost in government websites. It's all laid out plainly, so any retiree can pinpoint exactly what applies to them. No matter where you live, there's money you're leaving behind. It's called the Senior Exemption Playbook, and it's in the first pinned comment directly below this video. One tap, and you've got it. Now don't go anywhere, because the next section is the single most important protection most seniors never use. It's the reason I recorded this entire video. Sylvia, documentation as the real shield. The protection isn't avoidance, it's documentation and transparency. That's the only thing separating a routine CTR filing that goes nowhere from a genuine problem. Take a woman named Sylvia. She's 71, a retired elementary school principal from Baton Rouge. Her brother passed away and left her $38,000 from his estate. She walked into her bank, deposited the full amount in a single transaction, handed the teller a copy of the estate settlement letter and the will naming her as beneficiary, and asked the teller to note the source on the record. A CTR was filed. Sylvia never heard another word about it. The documentation made certain of that. That's the principle. Deposit the full amount in one transaction. Bring paperwork that explains where it came from. A bill of sale for a vehicle. A gift letter from your child stating the amount, the date, and that it's a gift with no repayment expected, an estate settlement letter, a pension award letter, a Social Security notice of payment. Keep a copy. You'll probably never need it, but if the question ever arises, you hand over the answer instead of scrambling to produce one. Account structure, RMDs, gift tax, and IRMAA traps. There's more to protecting yourself here than the deposit itself, and this is where I want to cover several things that don't get discussed enough. One valuable habit is keeping your money in separate buckets, rather than running your entire financial life through a single checking account. Your checking account should really hold only 1 to 2 months of living expenses plus a modest cushion. It's your wallet, not your vault. A separate high-yield savings or money market account, FDIC insured, is a better home for your 3 to 6 month emergency reserve, and it actually earns you something instead of sitting at a fraction of a percent while inflation quietly eats away at it. Money you won't touch for a year or longer can work harder still in short-term Treasury bills or CDs. Beyond keeping your accounts cleaner and less likely to trigger flags, this structure solves a second, quieter problem. Idle cash in checking loses real value every year. It just sits there. If you're 73 or older and required to take a minimum distribution from a traditional IRA or 401k, a lot of people withdraw the entire amount as one lump sum in December and drop it straight into checking, which is precisely the kind of single large deposit that stands out. If your plan allows it, taking that distribution in smaller scheduled amounts across the year is not structuring. Structuring means breaking up a transaction specifically to dodge a report. A scheduled, ordinary distribution set up for planning purposes is completely legitimate. The difference is intent, and a routine recurring withdrawal reads nothing like someone trying to conceal something. Family gifts matter here too. There's an annual gift tax exclusion, $19,000 per person per year for 2026, that you can give or receive without triggering a gift tax filing. Go above that amount, and you're generally expected to file Form 709, not necessarily to pay tax, just to report it. Large, undocumented transfers between family members are exactly the kind of thing that becomes a headache if your account ever gets a second look. So keeping a simple written record protects you either way. 2 more things worth knowing. First, a single high-income year, a large retirement account withdrawal, a Roth conversion, and inheritance, selling a rental property, can push up to 85% of your Social Security benefit into taxable territory. Separately, it can trigger IRMAA, the income-related adjustment that raises your Medicare Part B and D premiums 2 years later based on that year's income. People take one big distribution, forget about it, and get blindsided by a higher Medicare bill years afterward. Spreading large income events across tax years when you have the option quietly protects you on both fronts. Second, if you're now using apps like Venmo, PayPal, Zelle, or Cash App for selling things or receiving money from family, know that activity can generate its own tax paperwork. And if those apps feed directly into your main checking account, it all blends into the same picture the monitoring systems are watching. That doesn't mean stop using them. It means keep that activity as organized as everything else. Your 6-step action plan. Before every large deposit. Step 1. Before depositing any large sum, gather the document that proves where it came from. The bill of sale, the estate letter, the gift letter, the pension notice. Step 2. Deposit the full amount in a single transaction. Never split it across days or branches. Step 3. Hand the source documentation to the teller in person and ask them to note it on the transaction. You're allowed to do this, and it protects you. Step 4. Maintain a personal file, physical or scanned, of every supporting document for any transaction over $5,000. Step 5. If you're moving your own money between accounts or closing one after a loss, do it as a single wire with a memo line explaining why, and retain both statements showing the same-day transfer. Step 6. Never, under any circumstances, break a deposit or withdrawal into smaller pieces to stay under $10,000. A large legitimate transaction is fine. Trying to dodge the report is the only thing that's genuinely dangerous. One final thing. Before you go, I want to address what I think is actually the most reassuring part of everything I've covered today. None of this means you should keep cash at home to bypass the banking system entirely. I understand the appeal. No bank, no reports, no algorithm watching. But that's a bad trade. Cash sitting in a house isn't insured. If there's a fire or a theft, it's simply gone, with no way to recover it. Large amounts of cash can create their own legal complications if you're ever asked to prove where they came from. And like idle checking balances, cash at home loses real value to inflation every year while earning you nothing. The answer was never to hide your money. It's to organize it. Clean structure beats concealment every single time. Your bank isn't required to explain any of this to you, and it isn't allowed to warn you after the fact either.